All right. Good morning. Good morning, everybody. We got CPI today, which means we have the opportunity for a liquidity gap play. I love this trade when it sets up. I have a post that I wrote on this. Obviously, it doesn't cover everything, but it will go in through some examples. These are the examples that I've shown before in previous morning briefings. Same pictures. It's the same conversation. These liquidity gaps happen all over the place. And we had a good one yesterday, intraday, which was fun. Great trades off of that one. So these things can happen anywhere, but on CPI, non-farm payrolls, things like that, it's like knowing exactly where the lightning is going to strike, right? So it's not guaranteed that we're going to get one of these setups, but 8:30 on CPI, non-farm payrolls, all of those, we have the potential to get one of these. Now, I use a 5-minute chart when I'm doing analysis. And so these pictures are all a 5-minute candle. And that's one of the questions that I've gotten from doing this little presentation on gaps before is, what time frame are you using? A liquidity gap candle can be whatever time frame you want, right? Because it's just the visual. The real deal would be inside of the order flow itself. So looking at something like Bookmap or Jigsaw, but most of you don't have that, right? So I'm directing you to look at a candle. It won't matter what time frame you're on. You're just looking for an outsized bar that left a range really fast. And you generally get that on CPI, non-farm payrolls, whatever. The link, you can just search OEC coaching liquidity gap on Google. It should pop. If it doesn't, hit my Twitter. I posted it on there. So there's examples of what you want to see and what you don't want to see, and a little discussion about the liquidity gap and the fact of we're really just looking at the dome whenever possible. But these plays, if we get it, make for a nice trade. And even if you don't want to trade it, if I can save you from going in the wrong direction when the market opens, then I'll take that. If the market had dropped to the downside and you were looking to go short that day, you'd have got run right the heck over because it was a liquidity gap to the downside, right? So at the very least, even if you're not going to trade the gap close setup, if I can, save you from getting hit, then it's a win. We're going to get a lot of data out of Japan tonight. So this isn't the only data we've got coming, right? There's more on the horizon, and we're getting a lot closer to triple witching. This will be the last week that most of us are trading on the current contract. We'll be rolling by Friday on TradingView, by Monday on Thinkorswim, and we'll all be in the December contracts very likely by Monday. There's always some scragglers that stay in the old contract right up to the end, but I don't do that. Japan's up right now, 1%. Everybody else just kind of hanging out, waiting, with the Dow down the most at 0.25%. We're going to get some jobs data tomorrow as well. So overnight, we've got Japan. Tomorrow, we've got jobs data. And then we got PPI. So we're getting CPI today, PPI tomorrow. And then Friday, import prices. And I mean, there's consumer sentiment, but it's sentiment, it's that fuzzy feeling of the market, whether or not it feels good. And I don't know, I'd rather have some hard numbers than the warm, fuzzy feeling. We're going to get some European central policy data tomorrow too. So, I mean, as you can see, this whole week, it's just nonstop coming at us. These are all big data points that on their own warrant enough attention that could move the market. And we're getting hit with it every day this week. We've got something big. It's Wednesday, so we're going to get crude inventories. Last week it was on Thursday because it was a short week. And we've got the 10-year today also as an auction. And like I mentioned before, if we have an auction at one of the 3 time frames, just assume that the other 2 time frames have them as well, even if you don't see them listed. So this is the 1 o'clock 10-year auction, but 11 and 11:30 may also have an auction. Plus 11:30 is the one you want to pay attention to all the time anyways, right? Always be ready at 11:30. We held underneath the volatility trigger yesterday in the S&P. We've got a market maker move this morning. It's not really large yet. Continuing to watch it to see if it's a true market maker move or not. As I mentioned, we're getting closer to the contract change next week. We will see that a lot, but it won't be real, right? It'll be them rolling out of their contracts and moving into the December. And that trading activity will show up because they're trading in the front end. We'll have to discount that and just ignore it. And that makes it pretty much a worthless tool for the whole week. But we're not there yet. Seeing it this week does kind of imply that we've got some hedging in there. If it continues to grow as we get closer to CPI and then fades after CPI, then we'll know that it really was a true market maker move. If it just stays here all day long and doesn't fade, then it's likely we're going to have to attribute that to the rolling and them, repositioning. Volume's looking good. Typically, if we've got a market maker move, we wouldn't get as much volume. So that kind of makes me lean a little bit towards the idea that it may not be a true market maker move. But it's not the first time we've had both, right? That they're in here hedging on the one hand and trading in the other hand. It is lighter volume today than we've had over the last 4 days. We are holding inside this range today. We're basically flat at 0.25%. We're only slightly closer to the lower edge than the upper edge, but we've got a lot of resistance overhead. The 3-week, the 10-week volatility trigger, 0 gamma, 10-day, 20-day, all of that stacked over our head, plus yesterday's high and the RTH open that's up there as well. That's a lot of stuff to work through. We've also got last week's midpoint to work through. $54.63 came into play yesterday. It was a level of concern for a while. We got really close to that 5,500. If we'd have made it above, then that last week's halfback, 55.32, which happens to also be a cog line. To the downside, if we reject against this 5,500, we start fading back the other way, then we've got 54.68 and 54.63. Again, that 54.63 keeps coming back in again and again. The 21-day average daily range hasn't really expanded yet. I know we had that big day on Friday, but that's really the only big day we've had. We've had a lot of days where we're just chopping sideways, holding the line. And if you use the RSI Laguerre, what we found using that indicator is that when a market is going sideways like this, it's winding up more and more and more energy. You can think of it like those old toys that we used to wind up and then set down and it would spin or run or do whatever. That's what the market's doing going sideways here. It's just cranking up more and more and more energy until eventually it's going to pop and make a move. There's no directional bias to that statement. We're not going to say that it looks bullish, it looks bearish, maybe it's going to go this way, maybe it's going to go that way. It's just loaded up with energy. You know, if you take your car and put gas in it, it's loaded up with fuel, it's ready to go. It's not giving you a direction, right? It just says whichever way you want to go, you've got the fuel to make the move. This is winding up, and we've got a lot of bricks in the wall of worry, a lot of reasons to believe that we could make a big move at any time. It's got the juice to do it. We're still within the week, the floor pivot of the week. That'd be 54.89. We've gotten through it, but we're still just hovering there. Markets, the ES market doesn't generally spend a lot of time underneath that weekly pivot. You think about last week, we were underneath it all week. And this week, we've been underneath it a lot this week. That's 2 weeks in a row, but we're testing it, we're fighting it. It wouldn't surprise me if we get above it. If we don't, right, there's always the other side of that coin. If we don't get above it this week, then there's only so many things that the market could do, right? We can stay here sideways into the end of the week. That's always a possibility. And or we sell off. If we sell off and cut Tuesday's low, then we're going to go to Sunday's low. We get below that, we can measure this entire range and project it to the downside, and that'll give us our levels lower. I don't think this market's going to take kindly to that. It's very likely going to increase significantly. It's not the distance, right? It's the rate of change, how fast we make that distance. On the other side of that, we do have today's floor pivot. We'll just hide the weekly there for a moment so we can see things a little clearer. Today's channel is completely outside of yesterday's channel. That's considered bullish since it is above. And price opened above today's channel, also considered bullish. Now, we cut through that channel since we've opened, but we are back again through it. It's still considered bullish from the bias of where are we? Where are we now? Where did we open? But we've got a lot of pivots overhead to deal with. And if you think about the IB is initial balance. There's a lot of ways that you can approach initial balance. The guy who really popularized this concept, he didn't specifically say the 6 o'clock open. He said the open, and the open could be whatever market you're trading. So if you're in Asia, then it's your Asian open, or London, it's the London open. US, it's the 9:30 US open, but it is also the 6 o'clock open in Globex. The open is for 1 hour, unlike a 5-minute open range or a 20-minute open range where you choose the time frame. The IB is always 1 hour. So if you mark out the IB from last night from 6 to 7, you'll see it's a very narrow range, right? And I've actually got too much here. It was a narrow range. A very narrow IB implies they didn't get a lot of work done and that they could expand, which we already did, right? We made that first initial expansion. If the IB had been really wide, then we would look at it as they've already got all their work done. They don't have any reason left to run an expansion at this point. Take that concept again when we get into the open today. We've got to get through CPI, which very likely is going to give us a very large candle, and it may or may not be a setup for a gap close play. And then there's the follow through. How do we open at 9:30? What's the market do once it sets the range for the day? And is it going to continue to wait in this hurry up and wait sideways mode, or are we finally going to break out and run even with all of this economic data still needing to come out? That's the big ask right now, right? The big question. We don't have an answer. We know historically, though, the market won't stay sideways forever, especially when it comes to the indexes. The market will just give up and flush it, or we'll get some sort of news that finally galvanizes us and kicks us into gear and gets us out of the range. Either one, we won't stay sideways forever. That's guaranteed. So you want to be constantly thinking about what's it going to look like when we do begin to expand, and not these little trick plays where we pop up and drop back down and then drop out of the range and come back in again, but a straight full-on expansion, 100, 150 points over a 3 to 5 day period. Big moves, right? $55.20 last week's volume profile. It's another resistance point overhead that we've are likely going to struggle to get through. Ten-day, 30-minute volume profile. It finally moved. It's now down to 55.20, which is also last week's volume profile. We were just looking at it. It finally moved. So we lost enough volume across the top that by default, it came down to this 55.20. That's different than having price sit here and build up enough volume and bring it down to him because it earned it. It just got it from default, right? Either way, that's the new point of control. And it can shift now between 5,500, basically, this bar down here, even lower down into 54.80, or it could stay where it is because this is now in play. That point of control has been stuck up there forever, and it's been out of play for a week and a half. So now we've got it back again. Definitely want to pay attention to where it is, because if we make any move to the upside, we're going to hit that level. And it's going to be an area where we expect traders to respond. We don't necessarily know if it's going to act as any sort of resistance yet, because resistance and support, those are past tense words. It did support a market. It did resist a market. We don't want to look forward and say that it's going to act as a resistance when we just don't know yet. But that's where the greatest amount of trading activity took place last week. And even from traders' remorse, if you got in last week and you're now back where you started, what are you going to do? You're probably going to do something with your trade. So just a high trading level. We expect activity at that point. The concern is that we'll do what we did back here. Now, the point of control wasn't there at the time, right? It was still up here. When it was up here, we got there and we got stuck there. We were just chopping around that point of control. And then we got dropped down into this zone and we chopped, but there wasn't a point of control there. There is now. The concern is that we're going to come back up and get stuck in that zone, and we're going to chop there again like we did back here. And now with a point of control there, we could stay there just like we stayed in this upper level a week and a half, just chopping and building. No VPOC to carry forward. We ran through it or opened into it last night, so we don't have anything there. It's a very narrow range as we would anticipate in front of an event. We're at the edge of the weekly expected move. We actually touched it yesterday before we faded back. 55.05, the edge of the weekly expected move. And again, this is just one of those things where We made the entire move really in the first day. The last 2 days, we've just been tickling around that area. We're supposed to close inside this range 80% of the time, but like we counted up yesterday, count the last 10 weeks, we've closed on Friday out of the box 50% of the time. So in high volatility market conditions, these ranges get broken over and over and over again. It's one of the signals of volatility is that we're closing outside the box. So that's a threat that we still have to deal with. We're still underneath the 10-day moving average. This has got to be resolved to get that expansion back up. And it's been a nice, smooth transition back up to the 0, but we got to get across it, get above the 10-day, and we'll go from there. For the 10-week, same thing. We're right there at the 10-week. Now, in this perspective, it's not really offering us anything that we didn't already know. We're not overbought. We're not oversold. We're not stretched. We haven't moved too far, too fast. It doesn't owe us anything. There's no mean reversion coming. Yay, great, right? We knew that already. It's not really providing any insight. Bitcoin is down this morning. And really, that's about all we have down. Solar is up. Gold miners, nat gas, bonds. The China ADRs are up. They're just not up quite enough. We need them to move a little bit more. And they weren't down all that much. So the China ADRs being up a little bit this morning, it's kind of nice because it's not a mean reversion move higher, right? If it was down 13% and then we see it up this morning, yeah, it's more of a mean reversion play. But it really wasn't down over the last 5 days very much. And we are up this morning. It's likely that it's just due to, say, 1 or 2 names, right? It's not BABA. JD's up a little bit. Not PDD. BABA and Baidu are up just a little bit, but look, the whole China space is still beat down. It's not ready yet. I know a lot of people are interested in catching this move when everything does start to turn around. And I don't blame you. It's going to be a great run when we get it, right? When it's time to go long China. It's not time yet. You can be the person who gets in early and just hold through the pain and the chaos, or you just wait for some good, clear signals that it's time to run it in the other direction. It's not time yet. And there are better names too, right? When it comes to playing in the China space, I like playing EDU. Of course, I remember when the short report came out on this and took it down from its lofty levels, but it's been climbing back out of the hole for the last couple of years after it changed its business model a little bit as it needed to. So we can see China's up, but that's not really all that interesting at this point. Solar being up and crude up a little bit, and that's a bit more of a rebound play. Crude's had a significant beat down. And I was looking at some data overnight on inventories and the CTAs and their positionings, and I don't think we're going to get much out of crude anytime soon either. So precious metals, silver, gold, pot stocks. That ties in a little bit with the debate last night, right? You got your trade package for whichever candidate. So this is one of the names that we would expect to see move after the debate. And bonds finally got above that 100 level, and it's still there so far this morning. We'll see if it can keep it. I don't like a gap up like that at the high of a range, because, you know, a lot of times we end up with a rug pull. This was also a gap up, right? So this is where we are this morning. We're above that 101 at the top of a range. Don't like it up there. We'll see if it can keep it. If it can keep it, it's crazy bullish, but it's not looking good at this point. We'll see. That's a big deal, though, to have TLT above 100. So we're waiting on data, looking at any of the equities to see what's up, what's down. You know, if it's from news, it may continue to keep whatever move it has. But if you're looking at sectors to see which sectors are hot this morning, which industries, you got to wait on the CPI. Anything we do before the CPI on analysis of the sectors is just going to have to be redone. So there's no reason to do it in the first place. Just hang out, wait till after 8:30, then do it after you get the report. It's the same steps that we take day after day after day, right? That's why we do the morning briefing. Show these steps over and over and over to get to the point where you can run them on your own. Be careful, be safe, watch the clock. Don't forget, we've got auctions today. Data tonight out of Japan, data tomorrow morning out of Europe, and then our own data tomorrow before the open again. It's just nonstop for the next 48 hours. It's going to be coming in